look on social media reports, find that people always be talking about having ideas but without action. So getting someone to finance your idea is a key element for you to succeed in business. So sources of capital include two main debt and equity, of which debt is the money that you borrow from either a commercial bank, family member, from credit unions, from whoever is available. So that's debt. And equity is your savings, the money that you will generate through your salary savings or savings from other incomes. And also there is also a possibility of a donation that you can get from a church organization or from any friendly person or international organization, NGO of some sort. Although this is less likely to happen under our circumstances. So firms they are a product of ideas. Once you have an idea, you are ready to establish a firm. A firm is a vehicle which can then be used to realize your ideas. And capital injected is either injected by shareholders or by lenders. So shareholders actually inject money. So if you want to be a business person, you want to establish a business, the capital, you must look at sacrificing something from your savings so that you become a shareholder. A shareholder is the person who holds a title to a certain business by virtue of having injected some money into that business. So for large companies, we're looking at how they raise capital is through listing. It may just be an idea there, but they don't have the money to run the business and operate. So they go for what is called an initial public offering. An initial public offering is whereby they call upon interested individuals to come and invest in the firm through buying shares. You know that your business will require 1 or 2 million, but actually we have assets of about 200,000 or less. You declare or you make a provision for 1 million shares, each share costing $1. So already if there are 1 million people, each one paying $1, you already have capital of $1 million. So that looks easy. Or if there are 1 million shares, right? And there are only 3 people. Someone is prepared to buy shares for 300,000. The other one for 500,000. Already there's 800,000. The other one for 200,000. So there are 3 shareholders, 1 with a majority shareholder. So that's how the big companies like Apple, Microsoft, and so on, those people we hear in the internet, the billionaires, it's not their money, it's the money that they generate through stock market. Just generating the idea, putting the idea there, starting to generate something, and calling upon the public to invest in the organization. So those are public listed companies. For ordinary shareholders are high risk shareholders because they have to bear the brunt if the company collapses or it faces liquidation or financial distress. Ordinary shareholders will have to bear the brunt. But preference shareholders are those shareholders who may say, I have my 10,000, I was supposed to buy maybe a Mercedes-Benz to use for work, but I want to invest it in Econet. You put the money in Econet, you tell Econet that after 1 year, I'm looking at a return of 2,000. So that will be your return on investment. 2,000 over 10,000 multiplied by 100 is the percentage that we are looking at. So that shareholder is almost certain that at the end of the trading period, he or she will get the money that he has invested plus interest. Now, the concept is high risk, high return. Often people are afraid to put up their money for investment because they don't know how the investment is going to perform. They may expect to get some profit, but at the end of the day, there is no profit that may come. So there is real risk that borrowed money or invested money will not be returned. So in that case, we have a loss, and there's potential or likelihood that invested money or borrowed money will be retained with interest, and that is profit. So banks play a critical role in ensuring that capital is made available. They play an intermediate role between borrowers and lenders. Obviously, out there are people with money, a lot of money is stashed in their bank accounts. They don't know how to use it. And there are people there who are desperately looking for money. They've got an idea. They will generate some money if they get some money from someone, but they don't have the money. So the issue is savers have money but no idea, and borrowers have ideas but they have no money. So there is need for risk transfer. The people who are actually doing the business will then transfer the risk to those who have no business but have the money. Now we come to the cost of capital issue. Suppliers of capital, be it commercial banks, I've already talked about the sources of capital, credit unions, private placements, or equipment suppliers. They require compensation for their capital, and we call this the rate of return. The compensation that they require to get from whatever amount they lend to you. So the minimum rate of return a firm needs in order to pay its suppliers of capital is called the cost of capital. Then we go to the issue of debt and equity. These are weighted. If a company is financed through debt and equity, we need to wait to see how much is equity and how much is debt for us to come up with what we call the debt equity ratio. So if, for instance, the debt is 40% and equity is 60%, it means that the company is financed more by equity than debt. And the debt equity ratio must be 1:1.5 or 1:2 to be for a standard operating firm, to ensure that the firm remains above the water and cannot be drowned or cannot face a hostile takeover along the way. So too much debt is not good for the firm, as the firm may experience a hostile takeover. But the debt must be kept within 1:2, which means that for every dollar borrowed, there are $2 assets to cover for every dollar that has been borrowed. So debt is important. If you don't borrow, you won't grow. None of us is born with money. So all the money that we get is either we borrow it from someone or we work for it over years. Then we can begin to make our own money from what we borrowed. So you must be able to borrow. If you can't borrow, then your chances of getting rich are very slim. And if it's a country without institutions which are prepared to lend money to people, it means that those people will remain poor. Because it is through borrowing that you can get money to start a business and acquire assets. Issues that are of concern when we are talking of big companies is on retained earnings. Once you start running the company, obviously you yourself are involved in the day-to-day running of the company, or you may want to employ some people to run it for you. So those people will have to determine how much, after the company has made profit, how much would they say is the retained earnings, and they also need to determine the dividend policy. It is from those dividend policies that you can also realize that shareholders may say after they get their dividend, they continue to acquire more shares or replow the money back to the company. So that is a continuous capital acquisition process that will be happening. The interest rates by government are also critical in the capital acquisition by individuals and firms, because if the interest rate is too high, it means borrowing is expensive and the cost of money is high, and people are not able to borrow. There is also a risk-free rate that you need to consider, the minimum rate that is set by the government to benchmark what borrowers are expected to pay. And the exchange rate, in our situation, you see that the exchange rate is volatile. So it's critical that when you think of trying to raise capital, you are earning in RTGS. Obviously, Zimbabweans are fond of, once they earn in RTGS, they go by the fourth street to look for US dollars. And they keep the US dollars, which is a clever way of storing value. Now there are gold coins, I don't know how they're going to operate. But the idea is that the exchange rate is an opportunity for one to raise capital. If you can get an arbitrage opportunity, if you are lucky enough to be able to borrow to buy from the auction where the rate is low, or you are able to access a lower bank rate or something like that, you then can get capital from playing around with the exchange rate. Well, also in